I have a small favor to ask that takes you literally a few seconds. If you like the first 100 podcasts and the guests that we have invited so far, can you do me a small favor and give us a thumbs up on any podcast platform that you are listening on? It helps the podcast more than you think, because the higher we go on the ranking, the more interesting guests we can invite. Thank you again for your support.
Let's do it. Let's do it. Broadcasting from around the world, you're listening to The First 100, a podcast on how founders acquired their first 100 paying customers. Here's your host, Hadi Radwan.
This podcast is sponsored by All-in-One, the premier fantasy sports site that is on a mission to bring all sports fantasy games under one roof. If you are into football, the Euro 2024 is coming soon. Head to www.allinone.rocks. That's www.allinone.rocks and register for free for the first Predictor Game. You can create free leagues, invite and compete with your friends, and show your prediction prowess. May the best team win. Richard, good to have you on the show. How are you doing today?
Good. Nice to see you and meet you, Hadi.
Thank you for stopping by. Let me give a quick introduction for our listeners. Richard Joffe is the founder of Honey Insurance, which is a digital home insurance provider that helps consumer access insurance through public information, satellite data, artificial intelligence to estimate their rebuild cost. And you've raised to date around 125 million since inception, and you had the biggest Series A round in Australia. Richard, thank you for stopping by. Take us back to your early days. Did a young Richard exhibit any signs of entrepreneurship early in your life?
Well, I'm old and gray now, so it's a long time ago, but definitely my grandfather was an entrepreneur, my dad was an entrepreneur, and they certainly didn't tell me what to be when I grew up. But I think if you grow up in an environment like that, it's much easier to normalize what other people feel is risky as actually exciting and interesting and creative. My mom was running around selling Trivial Pursuit tapes to Toys R Us, I remember, with us in the back of the car when we were 8 or 10 years old. And my dad had a bunch of businesses. So I think when you're in that environment, it just feels natural that you want to create and build something. And if it doesn't work, it's okay. So I think if you come from a family where it's a different environment, maybe you feel differently. But it was totally normal for me. And so I went off and started little businesses in high school and even university. I think I was nearly kicked out of university twice for being overly creative with business ventures. And then I went and I spent 3 years in the corporate world. I spent some time being a banker. I was at Morgan Stanley doing tech M&A and spent a bit of a misspent youth in consulting over at McKinsey. But I was never particularly good at those things, and I never had a passion for them. And I think if you have a sense for what you should be doing, and let alone if you're miserable in your job, like really, there's so much upside and so little downside to giving it a shot to creating something. You know, you can always go back and get a job, right? So I started my first one. I was about 24 at the time, and this is my third startup, but I've been building for 20 years now, and just love it. And at this point, it's very much like sport and a labor of love for me. So.
Amazing. As you said, a lot of people start their corporate job. What do you think are key characteristics that people should look for to see if they are built for a corporate world or they're built for a startup world? Because there is risk taking involved, and a lot of people don't step that fear of moving from a secure income into an unsecure income practically at the beginning of your startup life.
I think it's a big question, but I'll give you a few thoughts on it. I think firstly, it's important that you surround yourself with people who are consistent with the type of place you want to end up. So what I mean by that is, if everyone that you're around, if you're at an accounting firm and your only friends are working at an accounting firm, you're not going to have the data you need to help figure out whether or not that's the right thing for you to move, right? And that's for anything. You could be in retail, it doesn't matter, marketing, et cetera. So I think if you're curious to potentially take the leap and start a business, I do think you need to make sure that you're spending time with other entrepreneurs and understanding, practically speaking, what it means, right? You have enormous emotional freedom, in a sense. No one makes you come to work in the morning, but somehow you never would miss a day, right? So there's enormous amounts of pressure. It's very lonely. It's very complicated. Each of my businesses, I feel like I became a doctor in a sense. And then every business is learning a new specialty where you kind of know what you're doing, but you've never seen a brain before, never seen a heart before, never seen a liver before. And so you're, even after 20 years and having a few successful exits, the pattern recognition is there. But the reality is that each of them are their own unique creatures, and it's quite an ass kicking, right? And so I think you really need to understand what you're getting into. And for the right person, you can never do anything else. But I do think the starting point is making sure you're spending time with other people that have walked those paths and walked those journeys so that you're making an intelligent decision if it's the right thing for you. The other thing I'll say is that you do have to be in the right position in life. I've started companies without kids. I've started companies with little kids and now a bit bigger kids. And I can tell you that it's just starting businesses is very painful anyway. Like you have to have a very high tolerance, I suppose, for suffering in general. And without anyone giving you a high five along the way. And if you're doing it without a partner who's supportive or without enough financial resources, maybe if your partner's working, she can help or he can help pay the bills. I think that's a very different situation. You do have to be very intentional with making sure that your life is set up to go on that mission, right? It's not a joke. And so I think if you choose to do that, it's incredible, but make sure that you have a strong foundation in your life and that you have enough savings for a couple of years, that you have a partner who's supportive. If you've got young kids, they understand that this is a bet on your future, that you really could have maybe multi-generational wealth or be able to work part-time starting at a young age if you get it right. But the cost to doing that is high risk, high pressure, long hours, and everyone needs to be on board. So I think part of it is making sure you're surrounded by people that help you understand it. And part of it, I think, is making sure you have the base, the foundational base that allows you to go out and swing for the fences. Otherwise, it just collapses, I think.
We were chatting that you moved to Australia 5 years ago and you started Honey Insurance in 2020, almost 3-4 years ago. Take us back to that moment. How did you decide that this is the industry you want to start a new company, and especially that your background is not insurance? So how did you come across that industry?
My approach to founding companies has matured, I suppose, over the past 20 years. My first company, I did 4 or 5 little mini business case studies, essentially, on different ideas I had. I probably spent a few months and then I jumped in. The second one, I would say, was almost analysis paralysis for the better part of a year. I was almost too smart for my own good, and you start killing things that make sense and not doing things that don't, and what have you. And then this time around, I was very thoughtful and intentional about it, but it wasn't like that puppy dog love. I think when you're younger, you kind of sometimes chase whatever the shiny object is. Today, it's generative AI, and 2 years ago is something else, right? I think that I've come to realize that what I love about creating businesses and being an entrepreneur is picking a problem that's really interesting and then getting to work on it with really gifted, talented people, right? And I care less about the industry, candidly, or where I'm doing it, which I've come to that conclusion over a long period of time. So I don't particularly care for insurance as a category. What I find interesting is that it's an interesting consumer problem. My customers are not particularly happy. It's mandatory to buy home insurance. Every single person with a house understands the problem. It's hard to buy it. The claims process is not often fair and it's painful. People, even how the insurance is priced, doesn't take into account if you're a good actor and do things to protect your house as opposed to someone across the road who maybe doesn't. And so it's a category that just needs to be brought forward kind of 2.0 into the future. And so when I looked at it, I wanted to pick a business this time around. I've learned several things in the last companies. I think one of those things is the importance of picking an industry that's top quartile. And so insurance isn't a sexy industry, but the reality is I could be an average player in home insurance and I'd make far more money, and the probability of success is much higher than if I started opening a retail store, right? Or a restaurant, right? So you kind of want to make sure you're picking a top quartile space. Insurance is a wonderful high margin space. The existing players are very profitable. They make 10, 15% EBITDA. Customers are not particularly happy, and there's a very clear way you can add value. So I looked at it firstly in terms of making sure that the space was attractive. It's growing, it's high margin, there's room for new entrants. Then I looked at whether or not there was an interesting way I could solve the problem that wasn't being worked on at the moment. So that was digitization, so tech enabling essentially an insurance company and then giving away tech and services to reduce risk for people, which kind of creates this win. And then the third part was I wanted to create a company that played to my strengths. When I think about startups, I always think about typically 3 types of risk, I think. There's business model risk. So sometimes you come up with a new idea and you could invent it and create it and take it to market, but it turns out the unit economics don't work. Like it's just what the cost is to create it and the tolerance for customers to pay is not there. So that's a business model risk. And my first two companies, Park Assist and Stella, those were big innovations that no one had done before. They were very innovative. I took a lot of business model risk, meaning it was possible no one wanted to buy the thing. The second risk is really around technology risk. Again, in both of those companies, there was a lot of technology risk. We really could have got to the end of the rainbow, and it might have not been technically possible to build a find your car system with low resolution imaging devices. It could have been possible that you couldn't synthetically augment resumes with data science. And those were very complicated problems. And then the third one is execution. For Honey, I didn't want to take business model risk. I didn't want to take technology risk. I wanted to isolate it to execution risk, which was something I felt I was well suited to do. Now I'm 45 now. I started this at 40. And so it was the right time for me to be able to focus on execution risk. I didn't want to be in a situation where we did everything right, but for some reason we were working on a problem that we just couldn't solve. I think when you're younger, you do that because you don't have the execution capability. And I also wanted to stay in Australia. My kids are young and I didn't want to have to travel extensively. If you live in America, you can start businesses, probably only America, you can start businesses that you can get to multi-billion-dollar businesses without leaving America. I think almost everywhere else, maybe Germany or England, but there's very few verticals that you can enter thoughtfully where you don't have to live on planes again. And if I'm going to live in Australia for the kids, there was no point to me starting something unless I could stay local. So insurance made sense.
Yeah, amazing analysis. Thank you for sharing this. If you take us back to the early days of Honey Insurance, we'd like to know your tactics, your acquisition strategies to get your first few customers. But before that, is your model more of a B2C? So an end user comes to you and buys the policy, or are you utilizing third-party retail agencies or brokers to sell through them your products?
So we do both. So the business is about 50-50 through partners and direct. To answer your question on how I started, I was actually very concerned in the early days. I looked at what happened with Lemonade, who is a major player in insurance globally. And I really worried that the cost to acquire the first 100, even the first 10,000 customers just wouldn't make a lot of sense. And I'm not a digital marketing expert, right? And so I looked and I said, well, I'm a channel partner person. Like I've done that for my entire career. But I looked at the economics of the existing players in other countries. And I thought, you know what? I don't know if we're going to be able to build a direct-to-consumer business, certainly for the short term. And I really questioned if we'd be able to get to first base by doing that. And so what I did was I spent 2 years, 18 months, and everything in Australia is an oligopoly. And so what happens is there's between 2 and 5, it's kind of like Canada or some other countries, but there's 2 to 5 companies that dominate every single industry here. Okay. There's 4 banks or maybe 5 banks. There's 2 or 3 airlines, 2 or 3 alcohol companies, 3 retailers, 4 or 5 electricity and gas companies. But essentially the vast majority of each vertical in the industry is dominated by 2 to 5 players. And that's one of the reasons that it's been very hard, I think, for anyone to enter any of these industries, is that if you can become part of the oligopoly, you can print money, but to get into an oligopoly is extremely hard. And so I took a look at that and I thought, you know what, maybe the way to get scale and get customers signing up is to actually get the other oligopolies to give me access to customers and to beat up that oligopoly. So I spent about 18 months convincing about a dozen companies, the largest energy company, the largest home builder, all of these kind of the number one electronics company in Australia, which is like the Best Buy in America. So I convinced them all to put in about $2 to $7 million. And the first $40 million in the company was raised through all of these different distribution partners. And so they took it to market. They essentially went and started selling Honey Insurance through their channels. And some of them worked and some of them didn't, but it gave us enough breakout velocity to get to tens of thousands of customers. And that gave us the momentum that we could start to play with direct to consumer and start to build that side of the business a bit. But I think where most startups, I think, really do focus over index for DTC, for direct to consumer, I think that it takes longer to get a channel partner to invest in the company, but it's enormously powerful because if you can do that, you're almost guaranteed to get scale and you're almost guaranteed to survive and get there. Whereas if you are relying on just selling direct to consumer, most of the time you fail and die. Firstly, consumers are fickle. Most founders don't know or understand how to do that well enough to survive long enough with limited funds to iterate and make it work. There's a myriad of reasons it's very dangerous.
Amazing story. I'm very curious to know why would like these big companies not directly collaborate or partner with other big insurance companies? So what was your secret sauce to convince them to partner with a brand that at that point was not known? It's a startup. How did you play that, if you want, strategy to make them work with you and not with other carriers?
Well, I had a secret weapon, a secret asset, I guess, that the incumbents didn't have, which is that I had a worthless company. So I essentially went to them and I said, listen, the incumbents are worth 10 to $50 billion, right? The reason they're worth 10 to $50 billion is there's a couple of dozen companies like you that are selling their product, distributing. So this is an arbitrage opportunity. Why don't you invest $3, $4, $5 million into the business? We'll pay you the same distribution margin you're getting somewhere else. So you're not losing anything. But look at these economics. This is the value of the revenue you bring into my business. Like if we can sell the business for 10 times revenue in 5 years, then your $5 million investment is worth $75 million. And so listen, you're going to get the same $1 million a year in distribution revenue. But what's more important to you? The $1 million, which is not going to be up or down much. Even I think I can double or triple it. But even if I'm wrong, you get the same $1 million a year. But you're going to essentially transfer the value that you're giving to an incumbent right now. You're only capturing distribution, transfer that equity value and capture it yourself. And so I created a fairly sophisticated storyline and financial model around that, but essentially ran around to these incumbents and said, look, you're giving up the vast majority of the value that you're creating by only distributing the product and not by owning a piece of the company, which you can own. And of course, most of the people I went to, I think it was like 92 or something investors for the seed round, just to give you a sense. And I think we got 12 or 14 of them invested. There's a lot of no's along that journey. So it's a fairly sophisticated strategy and game plan. But it's enormously powerful if you can pull it off, because they now are in the tent with you. They're giving you feedback on the product. They're giving you scale. It's embarrassing if it doesn't work out. And so I say to everyone, we have to win or suffer together. Okay. But you have to have enough skin in the game that this is going to be painful. Someone has to get fired. Someone has to be embarrassed, but everyone needs to be suffering together until we get this right.
Makes a lot of sense. What was your strategy to get in front of the right person in these companies? Because you have LinkedIn, you have a lot of ways in, but sometimes the response rate is low. You might not find the right people. It might not be at the right time. How were you able to navigate these uncertainties?
Well, I think you always need to start with what you would do if you were on the other side of a negotiation or on the customer, right? So what is not going to work is spamming a bunch of potential customers on LinkedIn, right? Because that's just annoying to the right people. How would you react? Well, if someone who was credible came to you with a very clear problem statement and opportunity, and if that opportunity was addressing like a meaningful pain point, right? If it's not that relevant to your company, if it's not a top 5 problem in your job as a COO, a CFO, a CRO, whoever you're approaching, it's just not important enough for them to be distracted. There's a lot of inertia in big companies. You're just doing your day job. You want to go home and see your family. You're not interested in like another meeting, right? And so I think you have to be very clear who is the buyer, who is really the buyer who's suffering most and has the most pain with the problem you're able to solve. And then who is the person who is most credible to make those introductions. So all of my companies, one of the first things that I ever did was to start by saying who understands the problem space the best. And so it could be a chairman, it could be an early investor, but I think you want to be able to get someone into the business who can immediately open doors with credibility. So I don't want to mention names, but in all 3 of my companies, like for example, there were people who put in money. They got it at like 2 or 3 times the value, essentially through options or warrants, to get involved in the business. So it's very cheap. In the early days, you would say, look, put in 100 grand, 200 grand, 300 grand, get involved in the business. By the way, if you put in 200, I'll match it with $400,000 of warrants, but these are the things I need: a board seat, an advisory role. I need you to help with these introductions. So I think the starting point is, I don't think you do it alone. I think you need somebody else to be making those introductions. And I think that what you pay for that in terms of everyone has to have skin in the game. So it doesn't matter. It depends on the company. Obviously, in some cases, someone might put in $20,000. In other cases, $500,000. But that person has to put in enough money that they care. And you need to double or triple it for very specific support. And it needs to be public and visible. So they can't just not pick up the phone and not help. It's like, no, you're the head of the advisory board, or you're on the board, or you're the cornerstone for the investment round. But So I think you need to think a lot about where is the pain most great on the customer side, and then who is the most credible person to make those introductions, and you have to make it their problem and reward them for that, right?
Amazing. This is not your first startup, as you said. You have two exits before, not in the insurance space. What has been the hardest part of building an insurtech?
So I think one of the challenges with insurtech, I think there's two challenges. I think one of them is, how do you get scale very quickly? How do you break the sales cycle so you can get channel and distribution partners signed up quickly and actually leaning in? And for me, I found having them invest is a way to at least accelerate their involvement and the cycle time of them doing something. And then I think the second thing that's really hard is that, unlike other companies I've built, insurtech, you have to really have two companies. You need an insurance company and a technology company in your business, because I think there are a lot of insurtechs. Depends on what you're doing, obviously, in insurtech. But for the most part, most insurtechs, at the end of the day, they're still insurance companies. They may be tech enabling, for example, or they may be a platform that's tech enabling, but they fundamentally are playing in the insurance space. And I think a lot of people really forget that. I think a lot of insurtech companies really get wrapped up and say, no, I'm all tech, I'm tech, I'm tech, I'm tech. And that's true for some, but for the most part, they underestimate the importance of treating the business as an insurance company across the board, from data to compliance to regulatory. And it ends very badly for a bunch of reasons, I think, for many reasons. So for me, I had to go and figure out, how do I bring people in who have spent 20, 30 years in the insurance industry, and bring those people in for discounted salaries and equity instead of that. But they're people who understand the industry, but believe there's an opportunity to break and improve it. And then you also need to bring in these technologists like myself and you, who have spent time moving quickly, hyper iterating, break things quickly, right? It's a very different mindset. So I think insurtech, and maybe financial services as well, is quite unique as a space, because you have to combine these two types of people together. It's different than e-commerce or defense, or it's different to most other industries where you can just build a tech company, right?
Exactly.
Yeah.
Yeah. Is there a crucible moment in the life of Honey that could have gone the other way?
Yeah, as with all startups, we've had truly dozens of times where the business could have fallen apart or not made it. I was waiting for the underwriting agreement to come through, and before signatures, COVID started hitting, right? So I could tell you story after story, but I think even our seed round, I then did a convertible note and we raised 25 million. But if I hadn't done that bridge, I would have been out raising money in a terrible situation. So part of that is dumb luck and part of that is experience, as always. But I would say to you that the biggest issues that we've survived them because I did my best to make sure the best people were in the company, right? Instead of nickel and diming the best people and saying, well, you're going to have a bit less equity, or you know what, you're going to make 180, not 200, or, I really obsessed in the early days about getting the best investors, the best board members, and rather paid up for that, because it becomes a vicious cycle, right? Where the best people bring in the best people, they stick around for longer, the probability of your partner signing up goes up, it creates a virtuous cycle. And I think people sometimes become penny focused, not dollar focused, and they don't realize that you might shave 10% of the salary and a third less equity for that exceptional person. But then you end up building a $50 million business, not a $1 billion business, right? Or you don't make it in the end, worse, right? And so I think you really it's worth paying up for the best. And all of the hard things we've survived, honestly, not because of me, it's because we have an exceptional team, investors, partners, whatever, who are all completely aligned to getting the job done. And so before we hit a wall, channel partners who invested would step in and say, we can help if you need it. We have existing people on the team who said, listen, I've seen that problem. I didn't want to deal with it, but let me help clean it up, right? So people just get involved. But you've got to obsessively get the best people you can, because the likelihood of surviving is 1 in 7 startups from Series A, right, make it to meaningful cash returns. And so the likely outcome is death in the world of startups. You just have to accept that. And so you have to do everything you can to get the best soldiers on your team in the war, right?
Amazing. What's the principle that you live by that has served you well?
I think there's always a way to do anything. I really believe that. And so I always start with what the right end state is. What is the right end state? And then I work backwards for what's required to get there. I never look at my current resources or current constraints or the way the current industry works. I'm completely unfazed by that. So I always say, whatever the problem is, it could be fundraising, a new channel partnership, a new technology idea. I've done some insane things in my career, but I always start by saying, okay, well, what is the right end state? Because if that is the truth, if that is the way that it should work, and you're data driven and you're disciplined about thinking through the hypothesis, then it should work. You should get incredible people involved, and the money would flow, and the timelines would be possible, right? So I would say my biggest philosophy when it comes to business building is to always start with the end state, rather than really starting with like who the people are you have and how much money you have and how much time you have. I think people really tend to be obsessive with what the current pieces are on the chessboard, and the reality is the chessboard can have any pieces on it, right? If the stakes were right.
What's next for Honey?
So Honey will come to a point in 2 to 3 years where the business will likely IPO. We'll have scale to be somewhere between $1 and $2 billion, I expect. And we're continuing to push and focus on home and to launch other services and technologies to reduce risk for people. About 50% of accidents that happen at home are avoidable. They're not catastrophic floods and things like that. And we're really passionate as a team about figuring out, how do we make it just the click of a button? If you have a claim, how do we make it so you never have to ideally hit the button? And that's really, I think, the future of insurance is, how do we reduce risk as much as we can, right? And then secondly, how do you price individual risk thoughtfully and systematically? I think those are the two things that are big opportunities that really touch most adults in the world, right? And so I think if we're able to do that better, we'll make the industry a little better for everyone, a little fairer as well. So, but that's a long path. That's a 4 or 5 year path for Honey, I think, to get to a state that we're really proud of. That's very different to the way the industry works today globally. But it's very clear, I think, how to get there. It's just a lot of hard work now.
Richard, thank you for stopping by. This was an amazing episode. How can people reach you, and are you hiring?
We are hiring. So we've gone from about 40 to 120 people over the past years, and we'll hire another 80 people this year. So we're hiring. You can go on the honeyinsurance.com website. Then I'm at rich@honeyinsurance.com. So yeah.
Amazing. We'll put all of this in the show notes. We wish you the best of luck on your journey. Thank you for stopping by.
Thanks, Hadi.
Thank you so much for listening to the First 100. We hope it inspired you in your journey. If you're enjoying the podcast, please subscribe to our podcast on Apple iTunes, Stitcher, Google Play, or Spotify, and share it with a friend starting their entrepreneurship journey. Leave us a 5-star review. Your support will help spread our podcast to more viewers.